Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 12.83% year to date as of November 4th, 2023. Our goal here at Spy Trader Now, and what this video is all about, is we not only show you the charts of the S&P 500, but we also show you how I actually make the trades to get my return on investment. That is what we do here, and that's what sets us apart from the other people that are on YouTube that just show you, oh, the S&P 500 should do this, we should bounce here, but they don't show you the actual trades. They don't have a model portfolio, so they don't show you exactly how it would fare for it, how they actually trade their money. Where do they put their money where their mouth is, okay? So here we use investment grade capital. I know that the handle is Spy Trader Now because we do trade the S&P 500, but we do this not in our trading account, but in our investment account. And we do it with a very simple portfolio. We either have shares of SPY, we buy the ETF, or we do SPY options, or we are in cash. Here you can see currently our allocation of where we stand, and we currently have $22,000 in cash. So we have a nice healthy cash position. We are within 1% of beating the returns of the buy and hold investor. And when you see the equity curve of the model portfolio compared to the buy and hold portfolio, you will see the benefits of this trading strategy and how it produces lower downside risk with upside gains. Here are some past returns for Spy Trader Now. You see we've had the last 3 years have been fantastic. If you want to see how I do this, go ahead, hit that subscribe button, ring that bell, and help me by pushing down on that like button right now. Thank you. Last week, the S&P 500 gained 5.85% for the week. These are candlesticks. This is going back 5 years. I'm going to go through the charts in much greater detail later on, but here is last week's action. We are right butting up against this resistance lines, and I'm going to show you the support resistance lines in great detail later on. But here on this weekly chart, you can see where we stand. But last week was an incredible, that's a half of a year of gains in 1 week's action. Now here are last week's trades. The trades were sent out on 11/3/23, which is Friday, and they were sent out 15 minutes before the stock market, the NYSE closed. What we did was we sell to close all of our long calls. We had 3 long calls, and we buy to open 2 covered calls on SPY. And with the cover call, the exact cover call we did was with an expiration of 11/17/23, 420 strike, and we got paid a premium of $17.09 on Friday when we placed the trade 15 minutes before the close. Here are some of the trades that I have made in 2023. If you want to see all of my trades going back 3 years, you can head over to spytradernow.com. There'll be a link in the description down below, as well as everything that I'm presenting today. Just look in the description. You'll see links to all the different pages I'm going to present today. Now, we have a couple of open trades. I do have a stock trade that's open because we currently have 200 shares of SPY that we purchased on September 15th, 2023 for a purchase price of $443.19. If I was a buy and hold investor, I would currently be down about $9 per share. But because I've been trading this with covered calls and then buying the close the covered calls and stuff like that, I've still been making money on these 200 shares. And we were able to participate in the strong 5.85% gain last week because I held no calls on these 200 shares, so we got that upside appreciation. Now, I did close out the 2 long calls I told you about, and I'll show you that, but you can see the cash that we made here. Excellent return on investment we made on those short-term positions, 10-day and 7-day trades. Now, here is the equity curve for the model portfolio for 2023 year to date. You can see last week was incredible as far as how well it treated us, but it also treated the S&P 500 buy and hold investor good as well. Now, here is the equity curve for the buy and hold investor, and here's their last week's action. Now, here are the 2 equity curves combined. Now, the SPY Trader Now model portfolio is in blue, and the S&P 500 buy and hold investor is in pink. Now, you can see that their portfolio has been all over the place, and my portfolio is basically been on the slow and steady path with very little down days. I did experience a down week, not last week, but the week prior to that, because I had already started taking on long positions and the market came down a little bit more. So I didn't call the bottom exactly well. We're within 1% of beating the returns of the buy and hold investor. Our goal is to, before the end of this calendar year, is for our portfolio to be above theirs. So we want each and every year to beat the returns of the buy and hold investor. Now, here's the Fed Chair Jerome Powell. Here are some of the Here are some of the Fed rate hikes in 2022 and 2023. Now, here again are also some of those Fed rate hikes, including the most recent one, which the announcement came on November 1st, and the Fed skipped that rate hike. So the Fed has now skipped 2 in a row. The next announcement this year is going to be December 13th. Will we have a 25 basis point rate hike or a skip? At this point in time, the odds are favoring another skip, which is kind of incredible because next year is an election year. Generally, the Fed does not like to make rate hike changes during an election year because he doesn't want to sway the election or have an implication towards swaying the election. Now we're looking at things from the presidential election cycle theory, which states depending upon the year of the election, you have historical rates of return for the S&P 500 and historical rates of returns for the NASDAQ 100, symbol QQQ. Now, currently, President Biden is in the 3rd year of his election cycle. 2023 is the year that we are currently in. Historically, on the S&P 500, that has returned 16.3%. Currently, the S&P 500 buy and hold investor is up 13.52, giving another 3% to reach the historical average of 16.3%. Now we are looking at things from the bond market outlook. Now we have got to really be paying close attention to the bond market. Number one, the bond market is 4 to 5 times larger than the stock market. So these are considered smart investors compared to stock market investors. And we currently have some risk. And the risk is shown to us by an inverted yield curve, meaning that the longer term treasury rates are yielding a lower yield than the shorter term 3-month and 2-year yields. This is called an inverted yield curve. Do we have one? Yes, we do. That's why it is in red. This is not normal. It is abnormal. Now, here's the kicker. And we're getting closer towards a normalized yield curve, but once we do get the normalized yield curve, 1 to 4 months or approximately 100 days after we go and revert to normalization on the yield curve, the S&P 500, the stock market in general, experiences a dramatic downturn. Now, when I show you some ratio charts, we need to be very careful with our long positions once we get to that stage of the market. Now, we're not at that stage of the market yet, but we will be theoretically at that stage of the market within the next 12 months. So sometime between now and 12 months from now, the market is going to experience, the probabilities of the market experiencing a large downward correction of 20% are very high. And we do not want to be caught off guard with long positions, and we do not want to participate in that downward trend. We want to profit off of that downward trend. And there's several ways that we can do that, but we need to watch this to keep our eye on this inverted yield curve and normalize interest rates. Now, in addition to that, the bond market also has rising interest rates. The 10-year 1 year ago was 4.1. Today, the 10-year is 4.88. Not much of a rise, only 0.7%, but still it's rising rather than falling. Rising interest rates are more unfavorable for equity investors than lowering or falling rates. Now we're looking at things from a valuation standpoint according to CMV, link here and in the description down below. We are currently overvalued, and on a standard deviation chart that puts us at 1.0 standard deviations right here on the chart. Now, the difficulty with this is that it's difficult to make all your trading decisions because you can be in overvalued and undervalued conditions for years. All we're doing is just showing you where we currently stand. We are overvalued currently. On a PE ratio, that is 39.3% above the modern era market average of 20.2. Now we are looking at CNN's Fear and Greed Index. Here is our friend Warren Buffett, and currently we are in the fear section 42. 1 week ago, we were in fear at 27. There's 25, and we were just a tick above that. So we are coming up this way on the scale towards neutral greed and extreme greed. Now we are looking at the seasonality outlook for the S&P 500. And here we have a seasonality graph that's going back 20 years. Now, basically, it's showing we're in the month of November. In the month of November, going back 20 years, there's an 80% probability that we are going to close the month higher than it opened. Well, guess what? In the month of November, we are currently up for the month 3.94%. Look at that strong bar compared to these three red candlesticks that we just experienced. These are the summer doldrums. We were expecting softness in the market in the last 3 months because if you look here on the chart, here are the summer doldrums, August, September, and October. So we knew this, and we traded our portfolio in anticipation of that softening. And now we also are trading it with the expectation that we're going to have a nice profitable month right now. Now we're looking at things from a long-term outlook. This is a monthly chart for the S&P 500 going back 20 years. Long bull run, 2009 all the way to 2022. And you can see how the market did during that time frame. Then we had the correction coming down here, and then we had some trend lines drawn. Once we broke out above this one here, that was the clear indication on a long-term outlook that we are entering a new phase of a bull market, which what this appears to be right now. And that will continue to be the case as long as we stay above this support line and this support line right there. Now the MACD, which had topped and was coming down, looks like it wanted to cross below its signal line, but if this continues to go up, the S&P 500 continues to go up, we may not get below that signal line. We'll keep an eye on that. Now we are looking at things from an intermediate term outlook. This is a weekly chart. We're going back 5 years. And on this chart here, which was one of the earlier charts that I showed you in the presentation, you can see, especially here in the thumbnail, last week's action. These are called candlesticks. And on last week's candlestick, which is this clear bar, it was just an incredibly good week for the S&P 500. But, look here on the weekly, you can see that that is a downward sloping resistance line. Until we get above it, then it's going to take energy to get above it. Will we get above it? I believe we will, but I don't believe we're going to get above it next week. I think we're going to have a little bit of backing and filling because last week's action was just there was such a good profit last week that I think there's going to be a little bit of backing and filling. And I'll show you later on exactly how I plan on trading what I am seeing in this market. Now, we're looking at things from a short-term outlook. S&P 500 daily candlestick chart only going back 6 months worth of data. You can see the candlesticks really well. I have a lot of extra lines in here because I like to monitor exactly what the market is doing. So right now you can see that we came up here. Oh, and I also got my trades in here so you can see my actual trades. Now the last trades that I did, which I discussed earlier, was on Friday, which is this candlestick right here. Now, I didn't really discuss this in earlier videos, but I want to explain to you about market conditions, bull and bear markets. What's a bull market? A bull market is when the 50-day, by the way, I've got multiple trend lines here. So I've got the 50-day in simple moving average in green. I have the 200-day simple moving average in black. This black line is the 200-day. I also have the 5 and 8-day exponential moving average and the 20-day exponential moving average. But for right now, let's just focus in on the green 50-day, because this 50-day is a lot of market people look at the 50 and the 200. And when the 50 goes below the 200, it's called the death cross. When the 50 comes above the 200, it's called the golden cross. It never did cross the 200, but those are just some terms if indeed it does cross the 200. But what I'm more interested in is the slope of the 50 and where we're trading at in relationship to this slope. Now let me explain. Here you've got a nice bull run from April all the way to August. Now look at the slope of the 50-day moving average. Here it went slightly positive, then we increased the slope to more positive, and the whole time the trading took place above the 50. And we were in this trend channel right here. So this was the time you wanted to go long. Then the market softened. Then it started to trade below the 50. But when it did that, the slope of the 50 was still up to neutral. Then the slope changed to more flat. And then right here on this candlestick here, sometime in September, this is when the S&P 500 changed its slope. Now the 50 is on a negative slope. Well, that's very bearish for the stock market. And now we're trading below a downward sloping 50-day moving average. So the time to potentially get out of the market and be really safe was when we tried to get through the 50. Here on this candle, we came up, penetrated through it in intra-day, but then could not close above the 50, and then it took a dramatic downturn after that. On Friday was the first week since we've experienced a downward sloping 50 that now we are trading above a downward sloping 50. Now, as a long-term stock market investor, you want this 50 to go flat and then to go up. And the only way that it can do that is if you have more trading above the 50 than below the 50. So, and we need that to be in a good bull run, because we want to make money when the 50 is going slightly positive to more positive. This is when you want to be making money in your longs. And when you want to start taking money off the table when you're experiencing the exact opposite of this, which is this. Now, it's too early to tell if this is going to turn around and come back up. Now, we know from a seasonality basis that November and December are good months for the S&P 500. So here is my expectation. My expectation, because last week, the last 5 trading days were so good, and you see that there's a gap between here and here, and there's a gap, actually, let me show you here. See that gap between here and here, and the gap between this candle and this candle right here? I'm expecting these gaps to get filled next week. And so I'm expecting the market, and by the way, let's talk about resistance. I have several resistance lines. I have 3 resistance lines. One of them is this one here, based off of this downward slope here, a little bit there, and this high right there. We are just about kissing that right now. That is the first area of resistance that this market is going to reach. The next area of resistance is this line, based off of this high and this high and this high. So there is an area of resistance there. Then we come up here to this high, and that low. That's your next area of resistance. So we have to get through, in a short period of time between now and 443, and we're trading at 434, 3 areas of resistance. I suspect that we're not going to go through those. We had a really good week last week. Market has a couple of gaps that they should fill. I'm expecting next week for this to come down and do a gap fill. And I gave you a red arrow right there of kind of where my expectation is that the market should bottom, find some footing, and come back up. Although ultimately, because of this negative sloping 50, because all of this is going to be taking place underneath the 50, these, generally speaking, are bearish signs. So still, caution is advised. You certainly do not want to go hog wild on your long positions in this condition, because this is not a bull market. This is a market that could potentially be going from a bull to a bear. So we need to keep an eye on this slope, and I'm not going to be taking on dramatically big long positions until the slope of this 50 corrects. So we'll be watching that every single week. But I still have an expectation, due to seasonality, that the market is going to find a footing somewhere in here and then go up from there. And I'll show you on the last slide how exactly I'm going to trade this market. Now we're looking at a ratio chart with a numerator and a denominator. Now, normally speaking, and this one is the NASDAQ 100 compared to the S&P 500, and I also have the S&P 500 in blue and the NASDAQ 100 in green. The ratio chart is in black and red. When it is going up, it's black. When it is coming down, it is red. In bull markets, normally speaking, the NASDAQ 100 is going to outperform the S&P 500. Hence, the green is going to be above the blue. Right now, we are in that condition. Green is above the blue, and the ratio chart is above both. So we want to monitor this. The MACD is showing that it wants to cross above its signal line, which is bullish for the stock market, giving us information that looks like ultimately the stock market has more upside potential based off of this chart. Now we're looking at another ratio chart, but this one is the equally weighted S&P 500 compared to the normally weighted S&P 500. Now, and we also have the S&P 500 in blue and the equally weighted S&P 500 in green. Now, under normal bull runs from 2009 up to 2020, you can see that the equally weighted S&P 500 does outperform the normally weighted S&P 500. Now, the ratio chart, which is in the black and the red, fell off of a cliff 3 times, and this is going back 20 years, weekly chart. We fell off a cliff here, we fell off a cliff here, and guess what? In 2023, we have fallen off of a cliff on the ratio chart. The past 2 times, the blue line is the S&P 500 has fallen off of a cliff. The blue line, the S&P 500, has fallen off of a cliff. We have not experienced that falling off of a cliff yet in this market. This is another piece of information that is telling me once the yield curve goes back to normal, the S&P 500 could absolutely do one of these right here, taking us down 20% or more or less. I mean, it's hard to say exactly how much. I don't care exactly how much. I'm just going to guess and say 20%. I do not want to be caught with long positions, especially long call positions, during this time frame. So until we get beyond this, I hope we do experience one of these in the next 12 months, because then we'll be more confident to go with our long positions, because the market experienced, after falling off of a cliff, a great bull run and a great bull run here too. We can make some serious cake in this condition, but we just have to be careful when we are going to experience this condition, which may happen, high probabilities, in 2024. Now we're looking at the VIX, which is also known as the volatility index, which is the fear index. The fear index, which is this candlestick chart here, and then the S&P 500 is in blue on this chart. The VIX fell down the elevator, basically. I mean, it took the elevator down last week. And what happened to the S&P 500? Well, the S&P 500 is inverse to the VIX. When the VIX goes down, the S&P 500 goes up. Now, I call this 3 trading ranges for the VIX. This is the ultra low trading range, this is the low trading range, and this is a high trading range. When you're in the high trading range, that's when the risk of losing money in the S&P 500 increases. Right now, we are in the ultra low trading range of the VIX, and then your risk levels are much lower. And as long as we stay in this condition, the market is poised to go even further. I'm expecting next week a little bit of a pullback, come back in here into the low trading VIX range, and then back down into the ultra low, finishing out this year. That's my expectation. We'll see if that actually comes to fruition. Now we are looking at the Think or Swim trading platform, and here this is a 1-year chart for the S&P 500 candlestick chart, but here we've got standard deviations. Here is some information about standard deviations in case you are unaware of them. So the standard deviations are +2 and -2 in gold, +1, -1 in pink, the midpoint in the dashed green line. Here the green line is the 50-day simple moving average, and the black line is the 200-day moving average, and this pink wavy line is the 100-day simple moving average. So where do we stand? Currently on the standard deviation chart, we are at -0.5. And here you can see that we came down, almost got close to the -2 standard deviation before we hit the bounce. Now we're looking at the same chart, but on this chart, we're only going back 6 months. Now I want you to notice something. Notice how the standard deviation slope has changed to that more upward slope to slightly upward slope. So that's telling me over a 6-month time period that the S&P 500 has lost some bullishness, but it is still slightly bullish. Now on this chart, we absolutely kissed and penetrated the -2 standard deviation. But I felt highly confident that we were not going to stay in that condition and this market was going to bounce. That's why this chart here alone is the prevailing chart that told me you do not want to be short this market, you want to be long this market. And boy, that timing signal really paid off, because you saw in my equity curve earlier in the presentation how we made some solid cake during last week's action. And this is the indicator that told me what to do. Now, we're looking at the same standard deviation, except instead of going back 6 months, we are only going back 3 months. Now here, look at your standard deviations. They're not going positive, they're going negative, much like the slope of the 50-day moving average here in green, going negative. We are trading below the 50. Yesterday, Friday, was the first day that we had a close above 50 since the 50-day moving average went from a positive slope to a negative slope. I can't tell you folks how critical the slope of this 50-day moving average is and how we really need to monitor this slope and exactly what happens. We're going to see this week by week. I hope you stay tuned so that you also can profit off of these market indicators. Now, I put in here my buy zone and my sell zone. And I also have a couple of alerts. So with the Thinkorswim platform, you can put these alerts in anywhere you want. But I put it in here because you see how the market. So another thing you want to look at is you want to look at your low, your high, your low, your high. This is a lower high. Then we came down, went below this low. Now we're making a lower low until we got over to here, which is even lower than that low. Then we made a high, but that's a lower high. All of these things are telling you downward trending market, lower low. Now look what just happened. We are right here at this high. We have not made a higher high taking out this last high yet. I have an alert set for me at this mark right here, 437. You can see the exact number when the alert's going to be sent to me. If we start penetrating above that and we also stay in this area, then this market is turning around. But look where you're at on your standard deviation chart. You're getting close. You're already above the +1, and you're starting to hit closer to that +2. We know that 95% of all trading takes place between the +2 and the -2. So as you get closer to this +2 standard deviation, there's a 95% probability you're going to bounce off of it and come down. And this is why I labeled that as my sell zone. Now, I've already changed my trading, so I'm not waiting for it to get into this upper level. I've already changed it, so I'm taking more of a posture in my trading where I took on a covered call, and I took on not only a covered call, but an in-the-money covered call with a 420 strike. So as this comes down, I got paid, what was it, like 17 bucks a share on that in-the-money covered call. Well, if this market comes down into my buy zone area here, and this alert gets triggered at 423.50, which coincides with this candlestick right here, which coincides with these two market gaps that are probably going to get filled next week. Well, I'm going to take that call that I sold, made the $17 on, and I'm going to buy it to close it. And I am going to buy it to close it for pennies on the dollar, not $17. Maybe I'll close it for $5. I don't know the exact price. The price will absolutely be less than what I sold it for if this does indeed happen. Now let's say that I am wrong. I'm wrong in my trading and the market doesn't do what I want it to do. By the way, the market never does exactly what you want it to do because the market is what's referred to as the 800-pound gorilla. It's going to do whatever it wants to do whenever it wants to do it, hence an 800-pound gorilla. So this 800-pound gorilla, although these signs are telling me that the market should come down and soften, these are just probabilities, 95% probability. There's still a 5% probability that it's going to say the heck with Ken, the heck with what those probabilities are on his standard deviations. We're going north. We're going up here. Even if that were true, my in-the-money covered call is not going to, I'm not going to lose money because as time goes by, I'm still going to get, as an option seller, I'm still going to get I'm still going to get option premium depreciation because I sold the call. I didn't buy the call. And if indeed it does go up, eventually this will come down and correct, so I can keep rolling out my options. So due to my trading, I can make that still a profitable position to be in. And don't forget, I still hold 200 shares of SPY. So if the market goes up, I'm also going to take on the appreciation of SPY as long as I close out that option so someone doesn't take my calls away, which absolutely I will do. I'll roll it out, I'll roll it up. There's tons of things that I can do in order to continue to profit in this market. I have just given you a ton of information in this video. Now comes our critical thinking. This is the part that all those people that show you, oh, the market's going to do this, market's going to do that, but they don't show you exactly how they trade the market. That is what sets us apart. I am showing you exactly how I am going to trade this market with the information that we have fresh. So, as of November 4th, 2023, market summation, according to me, your host, Ken, with SPY Trader Now, on Friday, 11/3/23, we closed our long calls and we made great profit. Here are those call trades that we made that great profit on right here. Here's those snippets of those exact calls. So the first call, we held it for 10 days. We made 11% in 10 days. The other calls we held for 7 days, and we made a 63% profit. Here's the cash that we made off of that. And that was only with 3 calls. Now, I didn't feel comfortable, although I could have taken on more calls and made more cash here. But that downward sloping 50, there's a lot of, it's making me not so aggressive, just in case this market is going to turn against me. And once a market turns against you, it can happen fast and it can be very vicious. So you got to be careful. When your money is invested in the stock market, always remember that your money is at risk of losing money. So I always have that in the back of my mind. And I didn't start trading last week, so I've been around for a little while. So I've gone through enough hard times that I'm cautious on exactly how I want to trade. Now, let's see here. So we were able to participate. So we were able to participate in the 5.85% weekly gain by being long the 200 shares. So we made profit here in our calls, plus we were profitable in our long SPY shares. Now I did place 2 in the money covered calls because I'm expecting a pullback next week due to the strong previous week. My plan is to buy to close my covered call positions when SPY reaches 423.50-ish. I don't know. I'm going to see exactly how I trade that once I get to this point. When and if it gets to this point. And then I'm going to go long again. Now I'm going to take off my covered call, buy to close, hold the 200 shares going long, and then I will absolutely probably take on a couple more long calls like I did here. Now normally, I should say this, normally in a normal bull run, I like to pyramid into my call position. So I put in 3, 4, 5%, let that position get profitable, then put on another 3%, let that position get profitable, then put on another 3%, and continue that until I reach a certain point where I want to take profits. These moves are happening so quickly, the market is gyrating so quickly that right now I don't feel comfortable pyramiding into the positions. That's why you saw me take profits on Friday, because I don't know when this market is going to turn. Right now, this is the first day coming down from a negative sloping 50 that we've experienced. So I'm a little timid to go hog wild here. As I explained right here, I am still concerned about this market until the slope of the 50 SMA is positive for at least over a 1-week time frame, and we are trading above the 50. I need another week's worth of trading all above the 50 for me to start to feel comfortable going long. Okay, so we're in a good position as we are holding $22,526 in cash. So we've got a great cash position right now. So we're okay as we are right now in our model portfolio. I hope this has been a valuable video for you. If you have not done so already, hit that subscribe button, ring that bell, smash that like button down. You want to learn more about me, you can head over to SpyTraderNow.com. There'll be a link in the description down below. I thank you and I wish you good trading.